passive investing in real estate is not easy. And unfortunately, your job as an investor is to keep your investment passive. And that is no easy feat, because once you start digging into deals and you start analyzing markets, before you know it, you're putting in a ton of effort and your investment is no longer passive, right? And so what I want to talk about today is what are the key things that you can focus on as a passive investor to make sure that you allocate your time as efficiently as possible, allocate your capital as effectively as possible, and most importantly, sleep well at night, right? Risk is really important. It's most important to have under control. And so there's many ways to approach passive investing. You can seek out many different sponsors that are investing across different asset classes, strategies, and geographies, and you could try to diversify yourself, which I think is an extremely valid thing to do. You can also focus a ton on the numbers and crunch the numbers on every single deal you look at, or you can more so bet on the, what's the saying, bet on the jockey, not the horse, right? And you can kind of marry sponsors and then trust the sponsor to invest on your behalf. So I think there's truths in all these different strategies, but I want to share some concepts that I think are extremely valuable. So firstly, while diversification is extremely important, I think it's also a little bit of a myth, because the reality is when people think they're diversified, oftentimes they're not. Because, for example, if you're in the stock market and you buy Apple stock and you buy Google stock, it's very correlated. Those are very similar investments. So you think you're being diversified, but you're not. And it's the same in real estate. If you're investing in two, let's say, Sunbelt markets in multifamily real estate, you might think you're getting diversification by owning in Phoenix and by owning in Dallas, but those are fairly similar markets that are going to reflect and respond to interest rates quite similarly. And interest rates, unfortunately or fortunately, are one of the biggest drivers to valuations in commercial real estate. So with that being said, I wouldn't, as a passive investor, go to extreme lengths to achieve diversification. I wouldn't take your investment sum that you're looking to allocate and chop it down into tiny little chunks and then invest into 100 different deals, because again, that's going to be a lot of effort, and also you're kind of unable to really focus in on the best deals or the best sponsors. And then of course for a headache, you're going to deal with a ton of K1s that you're going to be chasing during tax season, and your CPA is not going to be your biggest fan. So in my opinion, I think picking and vetting a handful of sponsors is your absolute best way to go. You should, of course, develop a thesis around how to invest. Maybe you have high conviction that multifamily, like what we believe, is a very strong asset class that has big tailwinds for the next foreseeable future, 20 to 40 years, etc. The supply and demand fundamentals are extremely favorable, and so then finding the right markets to invest in is key. And then as a passive investor, you have to find the right sponsors that are implementing that strategy that you believe in. This can make your life so much easier as a passive investor, because if you can find a sponsor, for example, like us at Lone Star Capital, that you resonate with and trust, it can save you a ton of time, because you don't have to vet every single element of a deal. You can actually just place your trust and capital with us and go about your business, which is hopefully enjoying life, enjoying your family, and earning income in your career and business. So I think picking, let's say, 5 sponsors across different geographies and strategies will serve you extremely well by saving you a ton of time and getting you pretty efficient access to the best deals. Now let's talk about the numbers. So when looking at different deals, especially as an inexperienced investor, it's easy to get carried away and excited by sponsors that are promising high returns. But unfortunately, high returns on paper are just that. They're just on paper. And small tweaks in the spreadsheet can result in big return projections that may not necessarily pan out. Also, similarly, even if the projections are, let's say, fundamentally sound, but the returns are being generated through high-risk strategies or high debt leverage, that can also be something that you actually don't want to be in, even though the numbers on paper look attractive. So I think really educating yourself on the numbers is a really valuable thing to do as a passive investor. Now, I'm not saying you need to go out and become a financial analyst and become an expert in these numbers, but you should be decently well-versed in the high-level fundamentals, such as going-in cap rates, exit cap rates, growth assumptions, pro forma rents, and things like that. And if that sounds a little overwhelming, but interesting to you, then I invite you to check out the first book that I wrote, which is called The Definitive Guide to Underwriting Multifamily Acquisitions. And that book I wrote not just for active investors in the business, I also wrote it for passive investors that invest with us so that they can get a better understanding and have more transparency and trust into the process and way that we actually evaluate all the deals that we're doing. So like I said, don't chase necessarily the highest numbers, because at the end of the day, those numbers could not pan out. And actually, when chasing the biggest return, you could end up with a loss or much lower returns. So what we say in our business is we're in the business of hitting singles and doubles rather than swinging for the fences.